This program was brought to you by PennyMac TPO. Visit tpo.pennymac.com to learn more about becoming a partner and starting your journey to greatness. With the people, products, and technology to take you there, it's why they say, at PennyMac, greatness lives here.
Welcome to The Interest. I'm Mike Savino. The Fed did what most experts predicted, raising the federal funds rates by another 75 basis points Wednesday. And Chairman Jerome Powell reiterated that more hikes are likely when the Open Market Committee resumes in the fall. But not everyone agrees on whether this was the right move or what it will mean for the mortgage industry. Marty Green, a principal with the Texas law firm Polonsky, Beidel & Green, says that we believe the residential market will take this increase in stride as it's in line with Powell's previous comments. But other industry leaders think lingering concerns about the economy will push mortgage rates up to 6%. In fact, you all were split on whether this latest rate hike will have a significant impact on mortgage rates, according to our unscientific poll, with 47% of voters saying that it will, compared to 45% who don't think it'll have much of a difference. And another 8% of people who voted so far aren't sure. You can vote in the poll by going to nationalmortgageprofessional.com. Meanwhile, concerns about the economy are growing, with early estimates showing that the GDP shrank for a second straight quarter. The economy shrank by just under 1% on an annual basis in the second quarter. Meanwhile, numbers for the first quarter have been revised downward to a 1.6% drop. Now, that meets a very basic definition of what is a recession, but many experts, including Powell, say that we're not there yet.
So I do not think the U.S. is currently in a recession. And the reason is there are just too many areas of the economy that are performing, too well.
And many of the experts we've talked with say that if we are headed for a recession, it won't happen until early next year. But if we do end up in one, what will it mean for all of you? Our own Katie Jensen asked an expert.
As experts question whether we're in a recession, originators are left wondering what an economic downturn would mean for the housing market and their ability to write loans.
Well, that's the million-dollar question.
While the GDP continues to shrink, experts say underlying factors show the economy is still healthy. That's not just semantics.
2.7 million people hired in the first half of the year. It doesn't make sense that the economy would be in recession with this kind of thing happening.
It can have huge implications for consumer habits.
And I think ultimately the strength of the labor market is probably the most important aspect of this, because I think when people think of recessions, they think of people losing their jobs.
That includes home buying. Brent Nitre is Chief Financial Officer at ARC Mortgage. He said during a recent episode of our daily podcast, The Principal, that inventory will likely have a bigger impact on home prices than the economy, so long as a recession is mild.
The problem with affordability is that we just still haven't built.
But if wage growth isn't keeping up, why won't prices come down?
The labor market remains strong, then what might square the circle there with affordability is wage inflation. And I think that's probably more what we're going to see.
There's also questions about what the Fed would do if we get into a recession. Chairman Jerome Powell says the top priority remains to be inflation.
Price stability is really the bedrock of the economy. And nothing works in the economy without price stability.
Still, a recession will have some impact on the mortgage industry. Nitre thinks Ginnie Mae servicers could face the most risk.
You could see some people conceivably get wrapped around the axle, especially if they had, kind of a low credit quality portfolio.
But the vast majority of mortgage loans are government-backed. Nitre says the market is in a much better place than it was in 2008.
Yeah, ultimately, it's going to come down to cost cutting. I think that's the single best thing you can do.
For the Mortgage News Network, I'm Katie Jensen.
In other news, 2 more companies are showing earnings falling, including Freddie Mac. The government-sponsored enterprise saw its earnings fall in the second quarter by 33% from a year ago. The $2.5 billion in net income was also a drop of 35% from the first quarter. Freddie Mac financed 468,000 mortgages in the second quarter, including 262,000 purchase loans, and 61% of Freddie's loans were to low and moderate income families. CEO Michael DeVivo says that the company has enough equity to withstand a downturn, and he intends to keep working with underserved borrowers. As rising mortgage rates, house appreciation, and other economic factors challenge affordability, we are committed to working across the industry to promote equity and sustainable housing nationwide. And First American saw its earnings fall even further, down more than 60% from a year ago. Still, the company's $109 million in net income in the second quarter was an increase of 11% from the first quarter. CEO Ken DeGiorgio says that the company is trying to control its costs in case of a possible recession. Given the decline in residential real estate activity and uncertainty in the economic outlook, we're maintaining our focus on expense management, particularly in business units most impacted by the decline in residential transactions. Personnel costs were up 10%, but that was driven by First American acquiring Mother Lode Holding Company in May.
This program was brought to you by PennyMac TPO. Visit tpo.pennymac.com to learn more about becoming a partner and starting your journey to greatness.
For more on these and all of today's top stories, go to mortgagenewsnetwork.com.